Yeah, so Martin, I'm one of the partners at Index. I've been with the firm for not as long as you, but kind of about 16 years now. Most of that time in London, and now I moved to New York City about 2.5 years ago to open the Index office here. Index, kind of multi-stage fund, seed venture growth. I've been around for 30 years, invested in companies like Revolut and Figma and Scale and many others over the years. Reaction to the numbers, not really surprising. I think quite representative of what we're seeing on the market. You know, those averages, I think to something you mentioned, they're interesting, but they kind of don't really show the reality of the market, which is exactly this kind of bifurcation between some very frothy bubble-like behaviors in some of the top of the market, and then a regular market for normal company, which is much more the usual and very like what I've seen in the past in my past 15 years. I think one thing that wasn't in the data and that I would have loved to see is the role of NVIDIA in this environment and how much did they contribute.
That's actually really good. Like,
a
lot of those, like, I don't know actually if they're considered like a traditional investor, and if they are in the 250 billion, they may.
Yeah, that's because I think that is an interesting player that they have been underwriting quite a few rounds, especially some of the large rounds with big amounts and bigger amounts, which is obviously an interesting development, which wasn't really there in the previous era.
So round tripping is a thing of the past, Eric, right? Because we were both there back in the day.
The good old days of AOL. Hi, I'm Eric Hippeau. I'm a co-founder and managing partner at Hippeau. We have been in business for 15 years. We're New York based. And we are early stage investors, meaning that we first invest in the seed round, and then we follow on in the A, and then we have a growth fund for the B round in the days that there were used to be B rounds. We're generalists, and so we just follow wherever tech is going, and we discover new markets, discover new opportunities. We were well known we were pioneers in direct-to-consumer commerce, so companies like Warby Parker and Casper and Allbirds. Today, most of our companies are enterprise businesses, but I'll talk a little bit about the return of the consumer market. The slides really depict what's going on, but I think the thing that we have to note above all of this is the rise of the mega funds. This is a trend that's been going on now for a number of years, but in the past few years has really exploded. So if you look at the size of funds such as Andreessen or Sequoia or the crossover funds like Tiger and Coatue and others, they've become like venture supermarkets. In some cases, they actually the crossover funds do public stocks as well. So they're like a investment supermarket, and they're completely desensitized to the reality of valuations, and I'm sure that we'll get into that in a second. And while we are at the early stages of the market, kind of isolated from this, there's no question that there's a pull in terms of general valuations, which is worth talking about. And I'll finish with just one stat that could be derived from the slides that Jeff has shown, is that in the third quarter, in Q3, 40% of all investments went into 11 companies. We call them the Gen 11, and so that shows you the concentration of what's going on.
Nothing can go wrong with that. So talking about mega funds.
Yep.
Hilary?
I'll own it. So Hilary Gasha, I'm a partner at Insight Partners. We are one of those, I'm not going to use this term, supermarket investors. We do invest from Series A all the way through to late stage investing. Our strategy is really find the best software companies at any stage of growth, and frankly, growth is not stage is not a strategy. Momentum is a strategy, and software investing and focus is a strategy. So we'll do a Series A, and then we hold through an IPO. So this year, Hinge Health went public, but some of the other names that you might know are Shopify, Monday.com. Back in the day, we were investors in Twitter back back in the early days. And so, we have a very large fund. It's a $12 billion fund, and we are valuation sensitive. We're not just price picking and trying to pick up the cream of the crop. We walk away from a lot of deals that we feel are frothy because exactly what you were mentioning, which is the market is very much bifurcated. So the averages that you show are not really indicative of the fact that the Gen 11 skew all averages, but the actual median is that much smaller. And most of the companies are still raising a $20, $25 million Series A, and then you've got a couple who are raising a $100 million Series A. And what we are seeing is that those companies that do manage to raise these outsized funds, outsized sizes, they'll end up being, in a way, market makers. I'll give you an example like Harvey. Harvey's legal software, for those of you who don't know, but they've raised more than $500 million. And in a sense, by just having that much money, they land up being the winner because they can spend more on sales and marketing. They can spend more on advertising. They spend more on acquiring customers. They can spend more on technology. And just by virtue of having that much capital, they in fact can become the winner over time, whether or not their software is better. And arguably, ChatGPT can do just as good a job on evaluating some of the legal contracts that they do. But as they gather more data, as they get more customers, they are able to feed the models, and arguably over time, their models will get better. So I do think that there is a market to be made by those companies who have the ability to go and raise outsized amounts, and that comes a lot of times down to irrational exuberance.
I mean, the concept of king-making has always existed, but the numbers which are involved now in king-making, because, you would argue, well, does that mean that no one goes after RVs and the legal, market, which is ginormous, or will other VCs just say, oh yeah, we'll just plow as much money? So it's going to be so interesting. So when I invested so I know all of them, they're all my friends, which means I don't have to be nice to them. My thinking was, let's have one of the early leaders in sort of seed with me, Eric. I think of Martin as Index being sort of a cross-stage firm. You guys, like your sweet spot is sort of Series A, Series B, or you do a lot of seed.
Yeah, we do everything, but historically the DNA is Series A.
It's Series A, and you're one of a few who has been extremely successful, both in Europe and the US, starting in Europe,
yeah.
which is very rare. And then Hilary representing more the growth stage, even though Insight sort of has gone earlier and earlier over the years, right?
Yeah.
So that's a good perspective for this discussion that we'll have. So,
well, what we realized, part of the reason to go earlier, and I think Sequoia started early and they went the other way, which is they were doing Series A, and then they didn't do the Series B and the Series C because their funds weren't large enough. But these are their best companies. Why would you not double down on your best companies? And by the same measure, we're doing the event, initially a Series B and a Series C. Why would we not, dollar cost average down and do the Series A to start with? And so I think that's why you see folks playing across the spectrum.
Yeah. And then you have seed funds like us who raise opportunity funds to invest in our best companies so that so everybody does everything. Anyway. Because we're capitalistic and we look for ways to make returns for investors.
Yep.
So let's go into the shopping list, starting with you, Eric. So what are you guys looking for? What are you excited about? I've known you forever. We met 24 years ago, right? You were at SoftBank. I was still at Reuters. So you were really focused on the consumer. You were like the firm that was doing consumer better than anyone else. And then you switched to enterprise and you hinted you're back to consumer. So what's your shopping list these days?
Yeah, so I would say first that we have an advantage because we're entirely based in New York. We don't have any team member anywhere else, including on the West Coast. And so we try to live in this kind of cocoon where, every time I go to San Francisco, I think I'm on a completely different planet. And then I come back to the reality of New York. And so in New York, we have, the valuations have gone up. But certainly not to the degree that we see on the West Coast. Having said that, about 20% of our companies are on the West Coast, so we do participate there. We try to be disciplined because I'll just give you an example. There's a lot of pre-seed rounds that are done at 25 million valuation. We won't even look at them. Okay. So what happens is you raise a pre-seed at 25. That implies a seed at 40, whatever, 50 maybe. And so we don't do seeds at 50 or 40 because if we did that, then you have to do your Series A's at above 100 and then you still need to raise more money. And so by the time you've raised all the capital you need to get your company to break even, you're probably close to $1 billion valuation. If you look at the data, there's very few companies that exit at $1 billion valuation. And so if you then say, well, AI is going to change everything, the world is changing, we're going to see 4 or 5% GDP growth. You know, the world today is not what we're going to see 5 years from now. 5 years from now, it'll be common or normal to have companies at $1 billion, $5 billion, $10 billion. If you believe that, then yes, you would do that. I'm having a hard time believing that. So most of our companies are AI driven. Most of them are applications of sorts in law, in real estate, in fintech, which, by the way, New York is really good at because there's good domain expertise. But we are increasingly doing, we're going back to consumer because they're not AI driven, or AI has a role to play in the infrastructure, maybe, and all of that. But they're good old consumer companies. I'll give you an example. We just, it's kind of laughable to some degree, but we just backed Ben Stiller's soda company. All right, what has it got to do with tech? Not much, except his customer acquisition is going to, and his marketing is going to be tech driven, and all of that. But it's, we got in at, single digit. He's going to be raising money at, a lot more money than that. And we don't need a massive exit in the category. If we exit at a couple $100 million, $200-300 million, we make 10, 15 times the money.
Yep. Martin?
Yeah, it's funny because we've got pretty much the opposite approach on most dimensions, which is, we are global. So we have an office in New York, but also in London and in San Francisco. We work as one team across, basically from Tel Aviv to San Francisco. So that's kind of one of the differences. We are valuation insensitive, mostly. We actually think very often the very best companies are always always very expensive and always raising at valuations much higher than the average. We don't care about averages because this is a business of outliers, and we are just trying to increase the odds of being in one of those outliers. And we just need one per fund. That's very much the math. And then everything, usually things kind of, sort themselves out by themselves.
And to your credit, because he's modest and I'm going to mention it, they've done way better than that. So they have more than one of those winners per fund. Like, if you guys were in Wiz, right?
Yeah.
So Wiz, Figma, like recently you just killed it.
Yeah, Wiz, Figma, Scale, Dream Games. So yeah, it's been a good start of the year. And exactly, you need one to have a good performance, and then if you have more than one, then you have exceptional performance. So that's, we only really focus on those outlier companies. And I think as a result, that's also why we don't really have a shopping list, because by definition, those are outlier companies, and we back entrepreneurs.
So question though, like average ownership, like do you have a target ownership? Because you tend to back those early.
Yeah, exactly. So we try to, we want to be the largest institutional shareholder by the time the company exits, and that was the case in Figma. We're the second largest in Scale. We were I think the largest in Dream Games. We're the largest in Wiz. And so that is a consistent approach where, obviously the earlier you can get, the bigger the ownership. But when we see signs of greatness, we've become a lot better at being very aggressive, at doubling down. I mean, Wiz, we invested at every single round as much as we could, because we realized this was a very unique company, and that was going to drive returns for like a lot of our funds, not only the first one, but a lot of them. So that's our approach. I mean, in terms of sectors, we don't have a wish list because we follow founders. There are millions of founders, and they tend to have better taste than we ever could have. So we don't try to superimpose things and themes to them. But obviously, we've been doing a lot of AI. But the one sector which I think is relevant to New York in particular is healthcare. And so since opening the office in New York, we've been doing a lot more in healthcare, both on the services, kind of direct-to-consumer side, as well as the infrastructure, payment, insurance side of things. Some really interesting companies that are seeing great traction. AI obviously plays a big part. I just invested in an AI healthcare company. French founders in the US. But I think overall, the market tailwind is absolutely, I don't have to repeat them, they're pretty obvious. But I think that's one space where New York has emerged as the center of the healthcare universe globally, or at least especially in the US.
So all of you can try and go after Martin at the end of this panel because he can invest in you. Hilary.
If I think about what Martin said, this is a game of the power law curve, right? It is a game of outliers. We're co-investors in Wiz. And when we saw the growth rates of Wiz, so Wiz achieved 100 million in ARR in about 15 months, and that was the fastest we had ever seen a company reach 100 million in ARR, I think, at the time. Lovable started last November.
I think they didn't do us a favor with that fastest company to 100 million ARR, because since then, every single company is the fastest growing.
But all the others are, they're a cloud security company. They're the fastest cloud company to ever 100 million in ARR. Every other company now is an AI company. And Lovable started last November. They announced that they blew through 100 million in June, and yesterday they announced that they reached 200 million the first year anniversary. So we are seeing growth. Cursor is the same. They reached 100 million in 9 months. We're seeing companies grow faster than we've ever seen companies grow. And so yes, there's a lot of hype around AI, and people are talking about the bubble. But the outsized winners are truly spectacular in their growth, and we've not seen that kind of growth before. We've not seen that kind of adoption. And so, our job is to back those 1 or 2 or 3 of those a fund, because they are fund makers. And so the question is, where are you going to lean in? And it goes back to the same fundamentals it's always gone back to, which is how large is the TAM? Because a lot of the ability to exit at large valuations is about how large the market opportunity is and what the sustainable growth rate is going to look like. So I think we're still back to fundamentals when we really look at it, but we're also dealing in a world in which we've never seen growth and adoption like we are seeing with AI.
It's kind of ironic that the leading AI companies, and I'm not talking about the hyperscalers, I'm talking about the Wiz's of the world, et cetera, want to raise that much money when in reality AI is supposed to make you way more efficient.
Yeah, but sales and marketing, you have to own the market.
Yeah, okay, so you're going to go buy the market. I understand, but I think the AI story hasn't been fully told yet in the sense that what we're seeing in AI is a lot of kind of what I would call low-hanging fruit where, yeah, of course it's going to be applicable in law, and of course it's going to be applicable in healthcare. Healthcare is about 20% of our portfolio. What we're really looking for is the entrepreneur who's saying, I'm going to use AI for something that nobody has ever thought of before. Right? That's going to happen. That's typically the second phase. So we're still very much in the first phase.
Yeah. So Hilary, how are you thinking about valuations? Martin doesn't care about the valuations. He said it. Eric cares about valuations a lot. Where do you stand?
I think we're more in Martin's camp, which is we are disciplined if the TAM isn't large enough. We're disciplined if it's a niche market. We've just invested in healthcare business, AI coding for home health agencies. I mean, it's a very niche market. We paid a very reasonable 4-12 multiple on that. But even so, those 4-12 multiples are anywhere between 15 and 50, depending on the size of the opportunity. But then, slower growers that are growing at 30% or 50%, not 100%, we're paying slightly more than kind of public market valuations. We're paying, current, current year multiples of 12 to 15, give or take, and 4-12 multiples of, slightly less than that. So, I think that it is a bifurcated market. I think that depending on everything depends on growth rates, and everything depends on market size. 100%.
Like 1, 10, 100.
If you're doing 100, 1, 10, 100, you're going to look at off the charts valuations. If you're doing 1, 7, 15, you're going to look at a very different valuation.
I mean, at Uncork, I would say we tend to be very reasonable, but I've learned my lesson by passing on Twilio at 3.5 pre because I thought it was too expensive. So now it's all like relative. And so for us, a pre-seed deal will typically be in the 15 to 25 post, right? A seed deal, I really have a hard time going to 40. So it's probably my walk out or walk away sort of price. I had a company, YC Batch, most recent, loved everything until it said at 40 cap and was like, oh, fuck. Not for me. But there's exceptions. So we're lucky to be in Grok, and we put some money into Grok at 6 billion because we think that the company has the opportunity to go like crazy sort of numbers thanks to their traction. And so we're trying like everything to figure out, okay, what is the net new multiple we can generate on a given investment. So let's talk about what you guys may have done 2-3 years ago and wouldn't do anymore, like in this AI first world. Are there sectors, types of companies that you've decidedly said, nope, no more? Hilary.
We always learn to eat our words, and we called insight partners, but sometimes we talk about hindsight partners, which is hindsight's a great thing. I wish the ones that got away. I mean, one that we should have done and we didn't do. So we had the opportunity to do OpenAI very early, and we had the opportunity to do Anthropic very early. And we said to ourselves, these are going to be commodities. The LLMs are just going to be, data. And there's going to be nothing that differentiates one model from the other. And we were wrong. And so now we've just done a very expensive Series D and Series F in Anthropic. Because what we're seeing is the models are getting more sediment. They're adding applications into the layers. They're becoming much more specialized. I mean, Claude, I'll give you an example. In our diligence, we use, obviously, a lot of AI. And, one of my analysts uploaded an income statement and said to Claude, can you just create the balance sheet and the cash flow statement for me? And it was perfect. Perfect. Took 3 seconds. We're taking them 3 days or 3 hours or much. It's just perfect. Like there was no reason to do anything further. So we're seeing these capabilities emerge in these LLMs, the shopping, things like that. And so that's why we've decided we sort of ate our words, which is we actually decided to go in because we think those businesses have just got such extraordinary growth still ahead of them, even though they're enormous today. I mean, Anthropic's crossing 4 billion and OpenAI is 12 or more.
Cool. Martin? Anything that you're definitely not touching?
Yeah, I think a few things 2-3 years ago, there was kind of still, if you talk about the bubble, for example, or the last bubble, I think we sometimes made a mistake when valuations are very elevated to look for good valuations, and that goes back to the price thing, and kind of value deals, and that's just not how we make money. And I'm sure some people are very good at making money that way. This is just not who we are. We're not value investors, and I would argue VC is just not a value investing game. Mm-hmm. It's an outlier game, and so I think we've learned our lesson. And if something looks like an attractive valuation, it kind of gives us.
It may hide something.
Yeah, it makes us more nervous than the other way around. So we're trying to avoid the value trap.
Cool. Eric?
I hesitate a little bit because what I thought yesterday I was going to do again, I'm starting to do again. So crypto, we didn't ever do a lot of crypto. We didn't think that our LPs wanted us to buy gold, and so we didn't do that. But we have some crypto infrastructure investments that are kind of doing okay. Everything about crypto is going to happen tomorrow, and so hopefully tomorrow is going to be great. We did some.
True for every investment we made, by the way.
We did some AR, VR investments. Obviously, that's
out.
Yeah.
Out. We stopped doing media. Most of us have a media background. So do you.
Yep.
And so we did media. We stopped doing media because anything that's advertising supported, forget about it. It's all in the hands of the big tech companies.
Yep.
But what we're seeing now is we did some podcasting platforms and that did okay. We're starting to do AI content investments. We have a company that produces or is going to produce full-length feature movies written by real people, screenwriters, a real director, a real photography director, but the entire production is done by AI. So we're starting to go back into media in that way.
So media infrastructure, essentially.
Yeah, exactly. Yeah.
Yeah, it's about the same for us. I would say it's been a long time that we have done anything sort of in media. We looked at a few media infrastructure, didn't sort of love it. At the end of the day, we're 5 partners, and everybody kind of goes after like a very specific kind of type of company. So whether it's vertical SaaS /AI, AI tools, AI enablement, and so on and so forth. I only do deep tech now, for example. But AR, VR, yeah, I did some investments 8 years ago thinking we finally were ready for AR, VR. We're not. So advertising, I have a hard time doing because I know there's going to be like AI-powered advertising, but like you said, it's all in the hands of the big companies. So I don't know that tools will change that. And then I think we're all sort of driven by like the founder or the founders, and we'll basically follow them. And I used to say, well, I'm pretty much doing anything in deep tech except maybe nuclear fusion, because that's hard. And my next deal is actually nuclear fusion. So just follow the founders.
But so maybe we'll talk a little bit about what we are doing that we didn't do. Power. Power is really important because of AI,
Yep.
but also because we need to modernize the grid, and the software can play a big role in this. We have a couple companies in defense tech, really started on the commercial side, but suddenly found a market with the army or with the military. So that's kind of interesting. So there's things that we would never have thought of doing just a few years ago that we're starting to do.
Yeah, it's interesting, these things of the thing that we used to do and we didn't do anymore. And when I love to hear what other people are saying, because when I hear that, it makes me want to spend more time in these categories. Some of the biggest misses at Index were categories exactly where we said, oh, we're not, like music is a really good example, where we did a couple of music deals. One was Last FM that sold to, I think, CBS for a couple of $100 million. It was really painful. They had all these label issues. And then there's this young guy that came from one of our companies. It was an intern at our company. His name is Daniel Eck, and came to see us and was like, yeah, I'm launching a new music business. I said, well, you're fantastic. We knew him very, very well. We thought really highly of him. He came to us and said, I'm going to do the deal with us. I'm going to give you a 10% discount because I really want to work with you guys and not with the other fund. It was like, we love you. Anything else than music, we would definitely invest. And the rest is history. And then by the time we realized, shit, that was stupid, he was like, well, now I'm fully, with Series C or something. And he was like, I'm good, thanks, guys.
And you would probably still have made a bunch of money.
And we still have made an absolute fortune at the Series C. Again, and you talk about advertising. We're the same. We haven't done advertising. We did Criteo, we did some good deals back in the days, and we haven't really done much. But then look at AppLovin, right? I mean, everyone said, okay,
everybody
it's dead.
passed on that.
Yeah, everybody passed. It's dead. The whole category. And then there's I don't know what it's worth today, but like 150 billion company-ish that just emerged out of nowhere and managed to eat Meta's lunch without anyone really being invested in it. So I think those, again, this is a game about Clavier, which also means all those. I'm really always really scared about heuristics or like all this pattern recognition. I think is very dangerous in this game, and I think that's where having worked in it for too long and becoming too jaded about certain things give you blind spot, and you may miss the next Spotify or the next AppLovin.
So not to finish us on a somber note, but not all our companies are AI first and doing the 1, 10, 100. We have a bunch of portfolio companies in the $20 to $100 million plus range, growing, 10, 20%, trying to preserve cash. They have raised a bunch of money in 21, 22. And we had to bring their valuations down because the marks were crazy back then. What do you guys do with them? Like, what's the path forward for that, messy middle, as people sort of call it?
Yeah. Go ahead.
We started an education program for our founders to educate them early. I would say, 3 or 4 years into the company, they have to start to think about their exit. The exit might be 4 or 5 years down the road. What does it mean? You're not going to go and do an IPO. So who's going to buy you? You need to develop a relationship with potential buyers. So how do you do that?
Yep.
Do you partner with them? Do you actually knock on their door, say hello? And then get into a secondary program. We feel very strongly that particularly companies that are kind of like 7 years old, 10 years old, they need to have a regular secondary program that takes care of their early employees and takes care of their early investors. And people like us, secondaries now is the second biggest exit for us. We're not going to sell our entire stake, but if we could sell 10%, 15%, start distributing money back to the LPs on a more regular basis, that's all good for everybody. And it's good for them too.
Yep. Hilary, do you want to wrap us up on this?
For us, we have an AI accelerator program, slightly different version of an education program, which is we're talking to existing CEOs around two things. They need to figure out how they put AI in their product, and they need to think about how they put AI in their business. So how are they going to drive more efficiency, better productivity by using AI across all aspects of their business, and what are they doing to make sure that they can pivot to being customer delighting through adding AI workflows features. So we're creating a sense of urgency. Those companies that are scale-ups, we're telling them you need the startup mentality. You have to go back to being that mindset of urgency in a startup.
Yep. I mean,
my answer would be they become M&A machines.
Yeah.
Meaning they either get acquired by a PE firm or by another player, get consolidated, or they become the acquirer and the consolidator, which we're seeing more and more
and
of those.
you fund those, or they
No, we
have enough cash?
Yeah, Hilary does.
Hilary does.
So yeah, they typically because we're talking about companies that are in say 40, 50 million ARR, profitable, like slightly profitable-ish.
Profitable-ish.
So they can raise some debt, some equity. We can go to a PE firm, get some equity, raise some debt, buy a few other competitors, and move your growth rate. You have an organic growth rate of like 30, 40, 50%. You can move that up to 70, 80%. You start generating a lot more cash flow because you're buying assets that are cash generative, or you cut costs, and then you start doing that.
And then the wheel spins.
Yeah, and then the wheel starts spinning. It's not the typical venture bet, but you can still get very, very good IRR, and then that big thing you either list or sell to a larger private equity or the incumbent in the space.
And we need to move back, cash to our LPs.
Yeah.
We're done. So I hope that this hour spent with us on VC topics were interesting to you. Good luck with the rest of the conference, and best of luck to you. Thank you, guys.
Thank you.
That was fun.